Hey guys, this is Alex Owari from ONG Tax and Accounting Services. So in this video, we're going to answer a very important question that comes up a lot with homeowners. And the question is whether a homeowner is required to pay capital gain tax when they sell their old house to buy a new house. Now, before we start, let me just throw a disclaimer or word of caution out there that this video is meant for educational purposes only, and it's not meant to be a legal or tax advice. If at any point in time you need a legal or tax advice, always consult with an attorney or a CPA or an enrolled agent who is going to be able to figure out your situation and help you out. So recently, I received this question from one of my clients, and the question was very simple, and it's whether they have to pay capital gains tax when they sell their old house to buy a new house. Now, this is how he structured his question. So he said he's a single taxpayer. He purchased his house 10 years ago and he's looking to sell and buy another house. Potential capital gain is going to be $550K, and he wants to know if he has to pay any capital gain taxes when he sells the old house to buy another house. And then 2, he is thinking that his capital gain rate is going to be 0%. So he has actually presumptively, or he has actually figured out in advance that he probably may be paying capital gains taxes 0, since capital gains is the only source of income. This second question is another source of confusion, and it's something that most people are very confused about on how capital gains tax rate works. So we're going to figure out whether that question too, or his assumption, is correct or not. The third question is whether there's any other federal taxes he needs to be aware of. All right, so we're going to try and answer the first question, whether he has to pay any capital gains taxes when he sells his old house to buy a new house. Now, the answer is yes. You're going to pay capital gains taxes because the sale of your old house and the purchase of the new house, they are both unique and separate transactions or events. Therefore, you will pay capital gains tax when you sell your old house to buy another house, but only after you've taken the Section 121 gain exclusion. So the Section 121 gain exclusion basically says that the home has to be your principal residence or main home, and you have to stay in that home 2 out of the last 5 years prior to the sale or ending on the date of the sale to be able to qualify for the Section 121 exclusion. So if you qualify for the 2 out of the 5 years rule, as a single person, you qualify to take $250,000 out of your gains. So from this example, this taxpayer made a gain of $550,000, but $250,000 is not going to be taxed. It's going to be excluded, assuming that he has owned the house 2 out of the last 5 years and he has used it. So ownership and usage is very important. We're going to talk about the main issues or some of the important issues with Section 121 on another video. But let's just assume that this person actually knows the rules and he qualifies for the $250,000 exclusion for single owners. All right, so we're going to address the second question here. He says that his capital gain is his only source of income, and he believes that his capital gain rate is 0%. So we're going to see whether he's correct or incorrect. Now, your capital gain rate is based on your overall taxable income, not just capital gains that you just made. This is one of the greatest confusions out there. Most people make the capital gains, they look at the capital gain table and they think they fall into the 0% category because they are only figuring out the tax rate using only the capital gain. But that's not how it works. You need to combine your overall taxable income. So for example, if you have wages and then you also have capital gains, you need to combine both income together to figure out what your taxable income is going to be. to get your taxable income, and then from there you use that taxable income amount to check your capital gain rate. When you have capital gains, like I said earlier, you may calculate your taxes in different ways, right? There's two methods that I'm gonna walk you through. Is you can use the ordinary income tax table or the qualified dividend and capital gain tax worksheet. In this process, we're going to go through how you can calculate your actual taxes that you need to pay using any of this methods. So you can either use the ordinary income tax table or the qualified dividend and capital gain tax worksheet. So whichever of this method produce the lowest tax liability, that's the one you adopt or take. To start calculating what the capital gains is going to be for this client, the capital gains after the exclusion in his case is going to be 300K. Now, how did we get a 300K? First, he actually said he made 550K in profit. We also know that he said he lived in the house for 10 years before selling it. So he qualified for the 2 out of the 5-year rule. And so as a single person, he gets a 250K exclusion. So when we take 250K from 550, we get 300K. Okay, so that is going to be his capital gains. And because he actually did not say that he has other source of income, we would assume that the 300K is what he's actually making, and that is what his taxable income is going to be. Remember, I said that when you have capital gains, you can either use the ordinary income tax table or you could use the capital gains and the dividend worksheet to do your calculation. And then once you figure out, you compare both of this calculation, you basically pick the one that gives you a much lower tax liability. And that's if you have capital gains. We're using the ordinary income tax table. You can find this tax table from using this web address here for 2021. And for simplicity's sake, we're using 2021 tax computation worksheet. As you can see from here, we know that the taxpayer had 300,000 in capital gains after the exclusion. We have to figure out taxable income, so we have to take out his standard deduction from the total capital gain. So that gives us 287,450. So if you're using the ordinary income tax table, what you do is you go to page 15 and then you're going to see this table here. Now, when you go here, it says that if you're single and your income is over 209,425, but not over 523,600, then put your taxable amount here. So you're going to put it here. You're going to multiply it by 35%. You get this result in column C. Now, column D, you're going to subtract 25,455.75 from this amount. And this gives you your total tax liability using the ordinary income tax table. When you go into this publication here, you can do the calculation yourself. So when you're using this one, your tax liability ends up being what? 75,152. So you can actually do the calculation for yourself. Now let's look at how the taxes is going to play out if you use the alternative method, which is using the qualified dividend and capital gains worksheet. Now this is a table for 2021 and it gives you what your rate is going to be at any point of your taxable income. So if you, for example, if you're single and your taxable income is up to 40,400, your capital gain tax rate is 0. If it's from 40,401 to 445, your capital gain tax rate is 15%. Now, we know that the taxpayer had a taxable income of, after we took out standard deduction from his total capital gains, which is 300,000, we got 287,450. So this taxpayer is going to fall into this range. 40,401 to 445,850. Ideally, he's going to be taxed 15% on this rate, but there's more calculation to it. His overall tax liability is going to be 37,058. Now, how did we get that? First, we know that his total capital gains after the 250 exclusion, the section 121, will be 300,000. And then we know his standard deduction is 12,550. After that, you're going to take out the capital gains exemption for single filers. So when you look at here, it says if you're a single filer and your taxable income is up to 40,400, then you pay 0%. So we're going to subtract this 40,400 from taxable income. So whatever result you get from this calculation here, you multiply it by 15%, and that gives you 37,058. Now, because this computation produces a much lower tax rate, when you compare it to the ordinary income tax rate, we got to be 75,000 here, which we got to be 75,152. We're going to opt for the lower tax liability using the qualified dividend and capital gains rate, which is going to be 37,058. So this is a really good deal. This is like half of what he was about to pay when using the ordinary income tax table. All right, now let's move on. Are there any other federal taxes I need to be aware of? So that's also a great question. So now let's look at what other taxes that this person is required to pay. So other than the taxes that we just calculated, there's also what we call the net investment income tax, NIT, of 3.8% on investment income. That typically applies only to high income earners. You would owe NIT or net investment income tax if you have investment income and your modified adjusted gross income goes over a certain amount. And for that amount, the IRS statutory income threshold for single or head of household is 200,000. So his modified adjusted gross income is basically going to be the 300K without the standard deduction. So when you take 300 minus 200,000, you're going to get 100,000. So if you exceed the income threshold based on your filing status, you have to determine whether your net investment income or the amount by which your MAGI exceed is higher. In this case, we're going to use the amount by which the MAGI exceed the net investment income. So it's going to be 300,000 minus 200,000, which is the threshold. So it only exceeds it by 100,000. So we're applying the fact to the situation. So his MAGI is 300K based on the facts provided, which means that we are calculating the modified adjusted gross income without taking the standard deduction into effect. Okay, so it's going to be 300,000. Now, because he has capital gains and have exceeded his filing threshold, which is single status, by 100,000. So this means that as a single person, to pay the NIT taxes, we first need to back out 200,000 from it, and then the remaining becomes what you pay taxes on. So after all your calculations are rounded up for the year, your net investment income comes out to 100,000. You will pay 3,800 or 3,800 in NIT tax. The result of that calculation is because we multiply 38% by 100,000. That gives you 3,800. Now, the NIT tax would be added to the other taxes we calculated. Using the capital gains and the dividend worksheet, we got 37,058. So you add the NIT to it, and you're going to get 40,858. So this is the total taxes that this person is going to pay when we factor in the NIT tax. Now, not everyone pays NIT. For a single filer, your modified adjusted gross income should have exceeded 200,000. Plus, you have to have an investment income for us to first figure out whether you have an NIT tax or not. Hopefully, this video has been helpful to you and you're able to know how to calculate your ordinary income taxes versus your capital gains taxes using the dividend and the capital gains worksheet. And you also know about the NIT tax, which doesn't apply to everyone. You must have had a very high income, plus you must have had also an investment income, things like capital gains, to put you into that NIT threshold. So I hope this helps you guys out, and if you have any questions, feel free to send me an email or book an appointment with me. Thank you and have a good day. Bye.